Welcome to this income shifting strategy session. My name is Larry Haley, and I will be presenting to you today our strategies, showing you how our strategies work from beginning to end, all the way through to financial freedom. So I'm going to get started. And so what you see on this first screen here is you see that it says, how much are you possibly paying in taxes? What we need to understand is, as an employee, employees pay the highest percentages in taxes. So no matter what you make, as an employee, you pay the most in taxes. And so as an employee, you're going to pay about a third of your income in taxes on average. Some people pay more, some people pay less. But on average, as an employee, you're paying about a third of your income in taxes. So you do the math. Whatever you make, just take about a third of that, and that's roughly what you're paying in taxes. Now, again, some people may be paying less because they may have other pre-tax deductions that lower their taxable income. But for the most part, you're going to pay about a third of your income in taxes. And so we know we pay a lot in taxes, but we really rarely ever look at the actual number. So this is just going to show you, what the actual number looks like. It's one thing to say, okay, well, there's a lot of money coming out, but when you see what you're actually losing, and then think about what you could be doing with that money that you are losing, it starts to open your eyes as to why a lot of people are living paycheck to paycheck, because the biggest expense that we have in our lifetime is taxes. So we're going to get started. This employee, for this example, and again, this is all for illustration purposes only. None of these numbers are intended to give you an exact number of which you could possibly get back, or whatever the case may be. But just to show you that this is how the strategies work. And so for the most part, this is exactly how things play out. But again, everybody's situation is different. All right, so this person, we're going to say this employee makes $50,000 a year. All right, so they make $50,000 a year. So an employee making $50,000 a year, as you see below, their total gross income is $50,000, but their total taxes paid for the year is almost $17,000, meaning they're going to come home with about $33,000 of the money that they get up and go to work for every day. Now, that's a huge number. $17,000 is a lot of money. There's people who work full-time jobs who aren't making $17,000 a year. There's people who work second jobs or aren't making $17,000 a year. So this is how somebody making $50,000 can actually be living paycheck to paycheck, particularly if they don't have good habits with the money that they do have. And what it tends to happen is, because we lose a third of our income in taxes, we tend to go in debt to the banks for another third of our income. So here's the thing. We make $50,000. That's our gross income. But here's the thing. When you go get a loan from the bank is going to make your loan based off the $50,000, not the $33,000. So the banks are setting us up from the beginning, because they're setting us up on a loan to pay a loan back using money that we don't even have. They base our payments on the $50,000. They don't base our payments on the $33,000. So already the banks are setting us up, because it's not fair how they qualify us on $50,000 when we come home with $33,000. So you see the monthly income. Monthly, our gross monthly is $4,100, over $4,100. Our net monthly is about $2,700, almost $2,800. So we're paying almost $1,400 a month in taxes, and that's money that the government is taking out before we get it. So what could we do with an extra $1,400 a month? A whole lot. So one of the first strategies that we do in MYECON is that we want to show you that, on top of the fact that we're paying about a third of our income in taxes, 80% of Americans are overpaying taxes. 80%. So the first thing we want to do is we want to help those people put more money back into their paycheck, because the government's already taken a lot of our money. We can't afford to give them more than we should be giving. In fact, we don't need to pay a dime more than we're legally required to pay. So that's the first strategy we're going to do. Typically, we can help associates get back, anywhere between $100 to $800 a month back in their paycheck. According to the government, the average person is overpaying their taxes by roughly about $300 per month. So that's money that we could be using every month to help us pay bills, help us stay on time, to help us pay off debt. So we're going to go through that. We're going to talk about that strategy in a second. But first, let's add some debt in for this person. So again, we're coming home with $2,700. Now, this person has got debt like everybody else. So we're going to add their debts in. We're going to give them a couple credit cards, student loan, a car note, a mortgage, just like an everyday person. So just so you can see the power of the strategy as we go through it. So first, let's give them a credit card. We're going to give them 2 credit cards. And their first credit card, they owe $3,000 on. And their monthly payment on that credit card is $75. We're going to get them another credit card, and we're going to say they owe $5,000 on that credit card. And the payment on that is $125. All right, we're going to get them a car note. Nothing too crazy. We're going to get them a $25,000 car, and their car payment on that is $350. We're going to give them a student loan, and the student loan, we're going to say they owe $50,000. And on their student loan, their monthly payment on that is $300. And then we're going to lastly give them a mortgage, and their mortgage is only $70,000, and their principal payment on their mortgage monthly is $400. So we'll say their actual payment is maybe $750, but we'll just say their principal payment is $400 because we can't add the taxes and interest and all that into the payment because that does not pay off the mortgage. So we're just using the principal balance there. So what you see here is that on the right side, you see the actual payment that where it says new payment. That's called the debt snowball. So right beside that, you see with the debt snowball, how long is it going to take to pay each of those off, and without the debt snowball, how long is it going to take to pay each of those off, and that's months. So what the debt snowball is that once we pay that credit card off, the first credit card off, $75 a month, it's going to take us 40 months to pay that credit card off. And then we're going to take that $75 and we're going to roll that into the credit card, the next credit card, and we're going to pay $200 a month on that one. So it's only going to take us 25 months to pay that off. And then we're going to roll that $200 into the car note and pay $550 on that. And we're going to keep doing that and using that money to work for us, using that money to work to get us out of debt, because we're already spending that money today as it is. So I know that most people, when they pay off a debt, they put the money back in their pocket, but we're going to use that money to put it to work for us. So we're going to keep using that to get us out of debt. So let's go down and see how much debt we have. So we got $153,000 in debt, right? And so today, it's going to take us 41 years to get debt free if we're not doing the debt snowball. That is, if we're not using that money to roll it into the next debt. And in fact, most people, when they pay the credit card off, if they ever actually pay it off, they continue to use it. So it's a rolling debt. So we're going to use that money we're going to do a debt snowball and pay that debt off as fast as we can. So just doing the debt snowball takes us from 41 years to 19 years. Now, 19 years is still a long time. But you got to understand, if you were to go out and get a mortgage of $70,000 and your payment was $750 a month with $400 principal, it's going to take you 30 years to pay that off. So we're going to go ahead and go ahead and do the debt snowball so we can get debt free, $153,000. And once we get debt free, that frees up $1,250 a month that we're paying out to the banks, that the banks are making off of us every month, right? And so when we get all of that paid off, that frees up an extra $15,000 a year. So we're paying $15,000 a year in debt that we're losing. That's cash flow that's going out of the household. But once we pay it off, that's cash flow coming back into the house. What could you do with an extra $15,000 a year that you have nothing else to do with but maybe start investing? And so that's what we're going to show you how to do, is how to start investing that money. But now, this is just to show you right now where you're at with the debt, how long it's going to take you to get debt free, and then if you just do the debt snowball. So now let's get into the actual strategies. So the first thing, like I said before, is we're going to show you how to correct your tax withholding to make sure you're not overpaying taxes. So for this example, because I have no idea how much a person will get back, I don't know what they have on their W-4 already, but when we correct the W-4, we want to make sure that we are breaking even. We don't want to owe the government, but we don't want them owing us either. So we need to get our money in our paycheck today. And again, according to the IRS, the average person is overpaying between $275 to $300. So we're just going to use $300 for this example. And $300 is going to put an extra $3,600 back into our household every year. That's an extra $300 a month. So where we were losing about $16,000 in taxes yearly, now we're only losing $13,000. So that's a little bit better. That's money that we were losing out on. We can put that money back into our pocket when we need it, so that we can pay our monthly bills, so we can avoid late fees and overdrafts and things of that nature. Now, monthly, we're only going to pay roughly about $1,100 in taxes. Now we're coming home with over $3,000, where we were coming home with $2,700 before. So we're a little bit better off now. But we're not going to use that $300 to just go out and start buying things and shopping and doing those type of things. That $300 got to go to work for us. We got to put that $300 to work. So now when we put that to work, we're going to put that into our debt elimination plan. So now with that extra $300 here, we're going to put $375 a month on that first credit card. Now we're going to pay that first credit card off in 8 months. It was going to take us 40 months to pay it off. Now we're going to pay that credit card off in 8 months with just that extra $300. And then we're going to roll that $375 into the next credit card. We're going to pay that off in 10 months, so on and so forth. And now we go from 19 years to get out of debt to 11 years. So we've shaved off 30 years of the time frame it was going to take us to get out of debt, simply because we're following a strategy, because we're doing a debt snowball, and that we're taking our money back from the government and using it to work for our benefit instead of loaning it to the government so that they can invest it and then they can benefit off of it, and then not even give it all back to us at tax time. So that's starting the process. That's starting the strategy. So now we're debt free in 11 years, and when we get debt free, now we have a cash flow of $18,600. That's the initial $15,000 plus the $3,600 that we took back from the government. So again, 2030 may not, seem close enough to you, but yet and still, you're talking about $153,000 that we're going to pay off in 11 years and be debt free. So that's just the beginning of the strategy. The next part of our strategy is our tax minimization strategy. So because our membership is also a business, now because it's a business, you get tax advantages that everyday employees don't get, which means that you can now write off household expenses. You can write off mileage. You can start writing off vacations. You can start writing off expenses for your children. You can write off up to 475 tax deductions because you simply have a business. And the law says all you need to do is legally attempt to make a profit for you to get those tax deductions. And so this is one of the biggest advantages to me of having a business, whether you make money in the business or not, no matter what your business is, whether you make a dime in your business or not, you've got to understand that we leave a lot of money on the table as business owners, because I've talked to many business owners who don't know the tax laws, and they're leaving a lot of money on the table because they don't know the tax laws. And the reason why the tax laws are there for you as a business owner is because the government knows that businesses, particularly in their first 5 years, struggle. And so they give tax incentives, tax advantages to business owners that help them, deal with the losses that, of their, because they maybe not make enough money the first year, the second year, the third year. And so now you can write off some of those expenses that you have to offset, not getting the income that you want to get. So we're just going to go over the 4 common tax deductions in this example. And that is car and truck expenses, house and communication expenses, travel, and wages for your children. So in this example, we're going to just, we're not going to say this person is going to do anything above normal than what they're normally doing. If this person normally drives a year, they drive, let's say, 14,000 miles a year. That's what they do every year on average, right? So for this example, I'm not going to write off 14,000 because it's not realistic for somebody to just get started and all of a sudden write off every mile that they drove. But I'm going to say, let's just say if we write off half of that. So we're going to write off 7,000 miles that, they're going to turn that into business miles. And so writing off half of that mileage that they're already driving is going to give them a $4,060 tax deduction, which at tax time is going to return to them roughly $1,015. Now, again, that's for illustration purposes. It could be more, it could be less, but that's approximately what they would get back just from writing off half of the mileage that they were already driving. This is why everyone should have a home-based business, because you got to understand there's money that we're leaving on the table because we just don't know any better. So now I'm driving my vehicle every day anyway. I'm going back and forth to work. I'm going wherever I go here and there. I just need to now, when I get to where I'm going, tell somebody about this membership. Tell somebody about the education that this membership provides. I need to get on the phone with somebody while I'm in the car on my way to work. I need to listen to some of my education, some of my training while I'm in the car, right? And so when you start to do those things and you start to do those things naturally, then most of your mileage you can start writing off. And eventually, this person can actually end up probably writing off majority of that 14,000. But again, for this example, we just use half. The next expense is the home and communication expenses. So the way the home and communication expenses work is you're going to get whatever your office, the area that you call your office in your household. You already have a room or a section, whatever that square footage is that you use. That percentage of your entire household is what you get for your household expenses. So to make it easy math, let's say this person's house is 2,000 square feet, and they got a room that they use that's 400 square feet. Well, that's 20% of their entire household. So they're going to get a 20% tax deduction for their household expenses. So we're going to put 20% here. And now we're going to put our bills in. So now these bills that we have that we're paying every month, they now become tax deductible, right? We get tax deductions on those, and the government got to give us some money back simply for paying our own bills that we were paying already. So we're going to give them an average gas bill. Let's say their average gas bill is $100. Depending on where you live, you may or may not have a gas bill. You may or may not have a very high electric bill if you don't have gas. But for this example, we're going to just keep it, simple. They're going to have an average $100 a month electric bill. We're going to give them a $60 a month water bill. Cable bill, we're going to say they get a $200 a month cable bill, and that includes internet and phone. Cell phone, we're going to give them, let's say, $160 a month cell phone bill. Now, if we were renting or leasing, we can write the rent or the lease off, but because we have a mortgage, we can't write the mortgage off, but we can write off the interest and insurance. And so that was a difference of $350. Our principal payment was $400, and our interest insurance is $350. And then we're going to give them let's say they have a home alarm that they pay $40 a month on. So all of that is tax deductible because they have a home-based business. So this is money that we were missing out on because we don't have a home-based business. But once you get a home-based business, you can write these expenses off, right? So that's $1,010 a month that we can write off. That's $12,120 a year, which gives us a $2,424 tax deduction, and that's an extra $606 that we get back at tax time by simply writing off expenses that we had before we had a home-based business, right? So now we're up to over $1,600 in just tax savings because we have a home-based business. So again, we're going through the strategy here. And so next up is another big one, is travel. So we're going to say this person is, fairly modest. Statistically, the average family spends between $3,000 and $5,000 a year on travel. So we're going to say, and I've met with people who have paid, who've spent $12,000 a year on travel. So we're going to say this person spends, we'll say $5,000 a year, and that's for them and their children. So they spend $5,000 a year on travel. That's another $1,250 that the government is giving them back at tax time, that if they did not have a business, they would not get that money back. So that's money being left on the table that we can't afford to leave behind. We already went over correcting the tax withholding, so we can't afford to let the government take that extra $300 a month, but we also on the back end can't afford to miss out on these tax deductions. Next up is wages for your children. Now, what that is you can write off up to $12,000 per child if you hire them in your business. Now, what does that mean? Well, you're already paying your children. You're already paying for their expenses. You're already taking care of them and doing things that you do for them monthly anyway. But when you have a business and you can hire them to work in your business, now all of those things that you were doing already becomes their pay for working in your business. So for this example, we're going to say this person has 2 children, and they spend roughly $5,000 per child each year. So that's $10,000 a year in expenses for their children. And again, These are things that you were already taking care of anyway. You're already paying for their sports. You're already paying for their lunch, and a number of different things. Paying for school, prom, homecoming, whatever it may be. You're already spending that money on them, and so now you can write that off. And the children must be between the ages of 7 and 17 to be able to do that. But once they are, you can hire them in your business, and you can give them. It's a home-based business, so they're already cleaning up the house. That's part of keeping your home-based business clean. And there are a number of other things that you can do that you can give them tasks, and you write out their task every month. And so you would say, hey, each month I'm giving you $400, and your job for the $400 is to do this, and that. You lay it out. You're doing what they were already doing. You just now have it structured so that you can make sure that the government gives you money back. So again, $5,000 per child. That's $10,000 total. So that's another $2,500. So this person with 2 children was missing out on $2,500 because they didn't have a home-based business that they can hire their own children in. This is why it's significant to have a business, because when we don't have a business to hire our own children in, and we send them off to go work for McDonald's and Burger King and you name it, well, those companies get that tax deduction because we don't have a business to hire our own children in. And those companies are going to get that same tax deduction up to $12,000 per employee. So now we are down to we've been able to save or recover that we were missing out on $5,371 in tax savings that we were missing out on. This person, before they had a business, had all of these same expenses. They still traveled and spent $5,000 a year. They still spent $10,000 a year on their children. They still had these same expenses. They still drove 14,000 miles a year. And so now, because they simply have a home-based business, it's simply worth an extra $5,371 for them. Now, what could you do with an extra $5,000 a year? You don't even have to work for this. What you do, you have to attempt, like I said, legally attempt to make a profit, but you're not required to make a profit, right? But, if you're legally attempted to make a profit, you probably will. But for the sake of this example, we're going to say you haven't made a profit. You're just simply writing these things off. And again, this is money that we're missing out on every year. And it's particularly important now with the tax law changes because many people who are used to getting large tax returns are no longer getting those large tax returns. And many people depended on those large tax returns so they can actually pay their bills down or shop or do whatever. So when we get this tax return back, we're not going to go and blow it. We're not going to go for the tax time sales or anything like that. We're going to actually put this money into our debt elimination plan. So we knocked our debt down. We were knocking it down. We got it down to, I believe, 11 years. And so now with this extra money, we're down to 8 years. So $153,000, we pay that off in 8 years because we corrected our tax withholding and brought back $300, and we wrote off our expenses and brought back another $447 every month. So a total of $747. We're going to start using that money now and put that towards the credit card, then roll that to the next credit card, to the car, and so on and so forth. So now we paid off $153,000 in 8 years simply by using strategy. And again, we have not made a dime in the business. So obviously if we did, we could actually do this even faster. So just to show you the power of the strategies that we teach. And again, this is not rocket science. We didn't make this up. We just put everything together so that it can work for us, so that we can put our money to work for us, so that we can stop leaving money on the table. So now this person, debt-free in 2027. And when they become debt-free, their cash flow now is $23,000 a year, almost 24. What could you do with $24,000 a year? You could probably buy a car cash, right? You can probably save that for a couple of years and buy a house cash. So we got to understand it's not how much we make, it's how much we keep. It's how much cash flow we have. Income is not as important as cash flow. And this is what we're helping people do, is recover cash flow. In fact, in MYECON, our associates since 2005 have recovered over $450 million, and another $100 million is projected to be recovered this year. Will be over $500 million in cash flow recovery using these strategies, using what I'm showing you right now. And this is how we've helped our associates recover that kind of money. So again, in 8 years, this person is going to have additional almost $24,000 that they don't have anything to do with it, right? Because they're debt free. Well, now we want to start investing that money, right? We freed up the money. We've got our cash flow back. We got all the money we need to invest, to build wealth. We're just losing it, and now it's time to start recovering it so that we can invest. So again, let's come over here to invest. So we got an extra $1,997.58 that we can invest, that we recovered from tax savings, from correcting our W-4, and from getting debt free. That's money that we were getting other people rich with. Now it's time for us to get rich for ourselves. So I'm going to invest $1,500 of that, and we'll keep, extra almost $500 in our pocket. So we give ourselves a $500 raise monthly, $6,000 a year that's coming back into our pocket. And now we can do whatever we want to do with that. We can use that money to go put it into an emergency fund. We can use it to plan for vacations or whatever we want to do. But, you definitely should be thinking about establishing an emergency fund as well. But for the sake of this example, we're investing $1,500. We're going to invest it for 12 years. And the reason why I want to invest it for 12 years, because it took us 8 years to get debt free. So we want to make the whole process 20 years. So this is showing what this person can do in the next 20 years. And if I can get it down any closer, I will. So at $1,500, we're going to invest this money. Now, I want to start off with a conservative rate. The reason why I want to start off with a conservative rate is because most 401ks are invested conservatively. And that's rates between 2 to 4%. I've seen people with 2%, I've seen people with 3%, seen people with 4%. But most 401ks are invested at a conservative rate. And what you got to understand is the lower your rate is, the slower your money grows. And what we teach in MYECON is we learn how to go get what we call wholesale rates, which are double-digit rates of return. These are the rates that the banks invest their money at, the top investors invest their money at, the corporations invest their money at. We want to get to that point. But we're going to show you just so you can see the power of the interest rate that you get to invest your money on. So we're going to start off with 4%. So at 4%, in 12 years, we're going to invest $18,000 a year. That's $1,500 a month. And so at 4% in 12 years, you're talking about $281,000 that our investment grows to. Now, you might be thinking that's not bad, but you got to understand when you retire, you got to live off that money until it's gone. What we learn in MYECON is that we need to live off the income from the investment, not the investment. And so you see on the right side, you see $11,000. That's how much the $281 will make us every year at 4%. We can't live off of that, right? Today we make $50,000. In 20 years, we're going to need to make close to $100,000 just to have the same lifestyle because of the cost of inflation, which doubles every 20 years. So we're far away from the income we need. And like I said, we don't want to live off that money until it's gone. We want to build up an investment so we can leave that investment to our family when we pass on, and we can live off the income from the investment while we're alive. So 4% is not going to get it. So let's try a better rate. Let's go with 8%. Let's see what that does. So 8%, we're still not getting it, right? We're still not there. So $368,000 again. Looking at that, because many times we've never seen that kind of money, we look at that and say, wow, that's great. But you got to understand, if you retire at 65 and you happen to live for another 30 years, you're not going to live off of that money for 30 years. If you try to live off of that for 30 years, you're talking about, about $3,000 or $30,000 a year, for the next 30 years. Actually, I take that back, $10,000 a year for the next 30 years. That's not going to work. So we got to get a better rate. And so again, we teach you how to go out and get the rates of return that you need. And now you got to be realistic. In some cases, we may need to invest more. We may need to invest longer. But let's keep going. So we're going to invest now at 12%. All right, 12%, we're getting somewhere. At 12%, we got $486,000 in our investment account that's paying us almost $60,000 a year. So we're debt free in 8 years, and in the next 12 years, in a total of 20 years, we became debt free, paid off over $150,000 in debt, and built up almost a $500,000 investment account in a total of 20 years. Now, many of us have been working 30 and 40 years, and we have nowhere near $486,000 in our retirement account. This is why it's critical, because we've not been taught how to prepare for retirement. And that's what we want to show you in MYECON. So now let me go with one more better rate. I'm going to go with 16%. Now, I told you your income needs to double in 20 years, right? We're making $50,000 today, and your income should double in the 20 years. Well, now our investment account at 16% is going to build up an investment account of $644,000 that pays us $103,000 a year. That's money that we don't have to get up and go to work for. That's what you call your money's working for you. So we were able to do what we needed to do in 20 years. We got debt free, and we didn't make a dime in the business. And here's another part that gets better. See, the $18,000 that we're investing, that $1,500 a month, that $18,000 a year that we're investing, is also a tax deduction. See, I wanted to show you first what we can do without writing that off, just to show you what that 16% rate can do. So in 20 years, we've achieved our goal. Our investment is paying us $103,000 a year. But we actually should be investing more, because we can write that $18,000 off and increase our actual tax return. So let's come back and write that off. So $18,000, when we write that off, that's an extra $4,500 that the government is going to give us back, because we're investing in a retirement account as a business owner. As a business owner, we're investing in a retirement account, and so that those contributions become tax deductible. And now when we get to that point, our tax return is almost $10,000, right? That's more money we can now start investing. So now we got $2,300 we can invest. So I'm going to invest $1,750. Oops. 12, $1,750. Now look at our investment. $751,000 in our investment account that's paying us $120,000 a year. And we did this all in a matter of 20 years. So, and again, we don't necessarily need $120,000. And another part you got to understand is, again, that income from the investment is not taxed the same way it is as an employee. Here's what you got to understand. As an investor, when you make capital gains, which is what your money making money for you, you get taxed at about 10 to 15%, where I told you before, employees getting taxed about a third. So that difference alone, let me give you an example. If you made $100,000 as an employee, you're going to come home with about $66,000. If you make $100,000 as an investor, you're going to come home with about $85,000. So that should tell you where we should be making our money at. So we really didn't need $100,000 to come home with the same lifestyle we would as an employee. We could have probably, made $80,000 and still come home with that same $66,000 as an employee making $100,000. So we really don't need all of that money, right? We don't need the whole $120,000. We can leave some of that in there and let it continue to reinvest itself. So again, that structure, that is the strategy that we teach. But there's still a few other things that I did not touch on, right? And we still didn't make any money in the business. So right now, I would think that by seeing what you've seen so far, you could easily agree that this is something that we all should be doing. So as a member, now understanding that if you start going out helping other people, you can actually start making money. You can make great money. But I'm going to use an example of just making a little bit of money. What if we just made an extra $500 a month? Right? So what if we just made an extra $500? So let me take this out first and say, okay, we're going to make an extra $500. And we can also, if we wanted to, we can actually contribute more to the plan if we want to, but we're not using that for this example. So with an extra $500 a month, now we're debt free in 6 years. Debt free in 6 years. And now I'm going to change the investment. I'm going to change it to 9 years. I'm going to change it to 9 years. And we're going to invest $2,000. Now, why 9 years? I want to see what we can do in 15 years, right? It took us 6 years to get debt free, and we invested $2,000 for the next 9 years. So in a total of 15 years, we built an investment account that's almost $500,000 that's paying us $78,000, and so now we got $24,000 that we're investing every year that we still have to write off. So now we're gonna come back and we're gonna write that off. We're gonna get that as a tax deduction. Now look at our tax return, over $11,000, which more money now we can invest. So now let's invest $2,500. Now you're talking about in 15 years, you build an investment account of $600,000 that's paying us $97,000 a year, and we're making $6,000 a year from the business by just simply getting out and helping other people do what we just saw. 15 years from now, and we paid off $153,000, and we paid off $153,000, and we built an investment account of $600,000 that's paying us almost $100,000 in 15 years, just by following strategy. And yet there's still more that I have not shown, right? There's still more that I have not shown. We want to also look at these expenses here, right? Can we lower these expenses? You know, we may be losing $1,000 or $100 a month in expenses that we can maybe lower, right? What if we lowered that the gas bill? What if we got a better plan, better rate, and we lowered that and we lowered that to 80? Now this is going to be money that you're going to save. It's going to be in your hand today. Now what this is going to actually do, this is not going to really change the time frame, but it's going to put more money in your hand today instead of waiting for it in your tax return. What if we lowered that electric bill to $80 a month? We got a better plan. What if we lowered this cable bill down to $120? You know, maybe we cut the cable out, we just get internet or whatever the case may be. What if we lowered this cell phone down to $120? So that's an extra $160 that we will put back in our pocket today by just going back and looking at our expenses and seeing what can we lower. We have people that have cut out over $400 a month in expenses. You got to look at your gym memberships, any other memberships that you have that you're losing money on, that you're wasting money on anyway, that's going out every month that you're losing. You got to cut that out so you can put that back into your pocket. You got to put your money to work for you. So let me take this money out here, this $24,000. Come back over to our debt elimination. And we still going to have that $500 that we're making in there. And so we still going to take 6 years. Even though we cut that money out, what that really did was lower our tax return and took that money and put it in our hand today. So we're still debt free in 6 years. Now, the next thing that we can do, and we also have a do-it-yourself credit repair program that's going to help you build your credit to 750 or 800 or better. So you can now, once you fix your credit, in a matter of 6, 7, 8 months, you know, no longer in a year, you should be able to improve your credit up to a 700 or better. Now you go back and you refinance any high interest loans you have. So what if this car note was 21% interest, and now we get it at 4% or 5% or 3%? And so what that would do is that would lower our actual payment, which means that more money would go towards principal. So even though our payment would be lowered, let's say it lowered our payment to $250 instead of $350, we would keep paying $350 on that loan because we want more money going towards the principal to pay it down quicker. So what that would actually look like, it would look like you almost had an extra $100 a month, you know, towards your payments. Same thing with the mortgage. What if we lowered that down, and let's say we lowered that and we saved $80 there? So that would, again, it would look like an extra $80 that if you keep putting the money back into the debt, it would look like a total of an extra $180 by refinancing the mortgage, refinancing the car loan. Student loans are usually pretty low in interest rates. You can actually look at the credit cards and see if they can lower those rates. But just with the extra $180, we're now debt free in 5 years. So that's using the entire strategy. That's correcting the tax withholding. That's the tax minimization by getting the tax deductions that you need. That's fixing your credit. That's looking at minimizing or eliminating any expenses that you can, and using all of that money to put into our investments. So we freed up a little bit more money here by refinancing, you know, our loans because we fixed our credit. We're making an extra $500 a month, and we come back over here and we're going to still invest that $2,500. And we're going to write that $30,000 off now. So Let me put that 30,000 in there. Now our tax returns are almost 13,000. So we're going to keep it at the 2,500. We're going to still keep it at 2,500. But now you're talking about a total of 14 years because we're debt free in 5, we invest for 9, and so in 14 years at 16% rate of return, which will show you how to get, you can build an investment account of over $600,000 that's paying you $97,000 a year. And again, you're making $6,000 a year from the business. And you can make way more than that, but I wanted to keep it conservative. I don't want to put anything crazy in there. So everything I've done in this strategy session is nothing that's far-fetched. It's just simply following the strategies. It's simply following the laws. It's understanding that this is what wealthy people do all of the time, and they've been doing it forever, and we just didn't know we can do it. But we now understand that you can build wealth from the tax laws alone, right? Even if we didn't make the extra $500 a month by doing the business, if you just get the tax savings back, which was over $5,000 initially, right? And then we got out of debt. There's people who don't have that much debt. There's people who don't have any debt, who can get straight to the investments, who can get straight to the tax savings. So this is the strategy session. This is how powerful our income shifting membership is, how powerful our strategies are, because we want to help everybody build wealth. And it doesn't matter how much you make. It doesn't matter where you're starting from. It's just all that matters is that you get a strategy in place and you follow it to a T. And obviously there'll be times where you fall off. There'll be some mistakes. There'll be times where you pull some money out to do some other things. That's natural. But just to show you the power of the strategies themselves, that's what we can do by just following the strategies. And so that's what MYECON offers in this income shifting membership. And our income shifting membership is only $34.95 per month, which is also another tax deduction. You're talking about $420 a year for the membership to do everything we just showed you. So again, that is the income shifting strategy session. Thank you for taking the time to watch it. Get back with the person who shared this video with you so they can get you started and get your plan rolling. All right? Thank you.